Because of coronavirus, you are going to be quarantined, but you have a choice. Do you A, quarantine with your wife and child, or B?
B. B. B.
I have agreed to do something called a webinar on financial modeling issues for the coronavirus. So this is what I am a little reluctant now. So here's the little this company. I have no idea who it is. They called me and I said, we got a bunch of people on your call, and I said, okay, and it's in Dubai time, so it's in the middle of the night for whatever. And here's what I'm going to do to try to address some of this. And here's what's in the video. I shouldn't laugh at myself for being an idiot. I'm going to try to show you some of the valuation effects. In other words, what's actually happened, and some of the databases that I've fixed. For this damn thing, I've gone back and fixed some of my database tools and all that you don't look at. And then I'm going to tell you some just standard kind of scenario analysis, but I think it's more effective and more important now in these times of absurd, total uncertainty than ever before. And then I'm going to go through a case study and show you how you can really make mistakes. This happened to me in 2008 when some people said, "Oh, there's this big, gigantic increase in inventory from the reduction in demand." I said, "Oh, I had modeled inventory incorrectly." And same with capital expenditures. If you cut capital expenditures, people make capital expenditures for a reason. You just cut them and assume that there's no consequence from cutting capex. You're going to have some problems. And then I'm going to show you some kind of different valuation tools and a lot of the effects of these things. These companies that have crashed, like airline companies and hotels and restaurants, they own big capital assets. Well, restaurants maybe don't know. And then if you own something that lasts 20, 30 years or 50 years in the case of a hotel or whatever, and you have a bad year or two, how big is the impact on value? That depends on the evaluation model and how you address the terminal value and the discount rate. So I'll talk about that, and then I'm going to talk about some credit analysis. How I'm going to get this done in 1 hour, who knows? I'm not going to make some idiotic comments about when the crisis, give some comments about when it will be over and all that stuff, and what the effect on our lives are and all that stuff. And I'm going to use this opportunity to tell you a few little general modeling ideas. And I think hopefully some of the ideas can be a tiny bit useful, and you won't waste a complete hour of listening to me. Okay, again, be careful with inventories. Inventory. Don't model them as a percent of cost of goods sold, because when cost of goods sold dramatically drops because you model as a percent of revenues, inventories don't really drop. If you use too high a discount rate, like about everybody in the world really does, I think, then you're going to overvalue the negative effects, because the negative effects are going to affect early capex cash flows. Don't distort the capex, and be really careful when you set up the scenarios. I'm going to give you all these models. Of course I will. And you can find them. I'm going to make a corporate model, project finance model, some kind of helpful structuring models. And I'm going to use this case of a Macy's, because they had a pretty big decline in stock prices. I don't know if you know who they are. They own some stores. And the first thing I'm going to do is demonstrate a little what's happened to the stock prices. Now, I have really worked on the stock price stuff, so I'm going to open this file. And again, I'm just practicing. I better have it open when I really do this, don't I? Okay. And what I've done is, it's so cool. You can now, I'm not going to show you how to get the data or anything else, but if I press false to all here, get all the stock prices. Right now, I wasted a lot of time on this. Ah, shit. I have these data tables open in my other thing, so I gotta close this file. Okay. That's gonna be our corporate model case, but this is so cool. You can go all the way back to 1927. And then I can go from that till 2020. Now, when I had to put this little recalculate button and all that in, and then I'm gonna, if I look at kind of stock prices in real terms, then you can see the crisis in 1929, the crisis in this 1987, Black Friday. No, it's not Black Friday. That's shopping day, Black Monday. And then the dot-com bubble, that was a big one. Then this one and this little thing over here is what we're talking about. Not quite that big. So I did some other analysis. This is kind of what I just showed you with the different valuations. This in 29, this stock went down by 88%. Oh, all the assets of the world. Oh my God. And then it didn't recover. The 87 crash, that happened. There was a loss of 34%, but it kind of rebounded. The dot-com bubble, which I really call the telecom bubble, well, you lost 50% of your value. The S&P, the NASDAQ off it was a lot more, but then it kind of recovered. NASDAQ now has recovered enormously, but it took a while. So that's that one. Then in 2008, again, it was about 51%, but it then all totally recovered. And the one we're talking about now, it's a little 22%. Even in the worst case, then it's going to come up now. I don't know. By the time I give this, maybe it's totally back. Now I'm going to look at some extreme cases. So if when I want to look at some extreme cases, let's look at this stock that we'll look at now. Now, whenever I've redone this, so what I'd have to do is, if I want to start, I'd have to start in 1992. Okay, and then, oop, it gives me this crazy thing, and I have to hit the recalculate button. So this one, ooh, the beta is 1.46. Look at the volatility of this. Now I should really be careful. I forget to do some of these things. I should take that out. And then you can kind of see this, ooh, it's not had a good story. Now another company, this airline company, they can had a bad time too. Now they started, if you see up there, it starts, I was about to point to they kind of started in 2006. God, I hate this. One day I'm going to figure that one out. They kind of had a decline here. I don't know what happened. Is that their bankruptcy? And then they had, oh my God, same kind of dramatic decline. Whereas if you unclick these ones, and unfortunately, when I look at this, oh, let's look at this Walmart company. They, a lot of people they actually had an increase in their share price. Of course, nothing had as much of an increase as Amazon. So this file is on the disk, and I think it works. I think it's starting to work. You can look at the IRRs and all that stuff. I'm going to close this file. I won't even save it because I really didn't do anything with it. And then so this one, you look at the and how am I doing? I'm going to have to. Shoot. I've already, only 8 minutes in. That's not so bad. Now I have some of these other companies. There's Amazon, there's our company. Now, the next thing I'm going to do is show you this file that nobody's ever looked at, and I worked so damn hard on this thing. And that's this file that has where you can download all the financial stuff. Now, I didn't realize you could do this. Well, I should have. It's kind of stupid. You put the little ticker symbol in. In this case, I'm going to use this Macy's. And then after you put the ticker symbol in, you press the button to collect all the data up here. You have to clear the sheets and collect all the data. All of this is explained on my website, and then you can look and see, what's happened to the EPS, what's the kind of background of this company in terms of return on invested capital. It's kind of come down, the earnings were down, not good story before, certainly before the financial crisis. What's their PE ratio? And I kind of put the equity stuff up here. What's their price to book ratio? What did I And then that's come down. I'm sure it's way below one now. It was kind of above one, saying they're earning more than their cost of capital, basically, or have. And then you can, whatever, look at EV to EBITDA ratios. Okay, this marries the financials along with the uh, uh, stock prices, so you can get kind of a little history, which is hard to get, on these public websites. Okay. So we now the other good news is we have a reasonably from this market. It really goes to market. It gets the data from Market Watch, and it gives a reasonable kind of layout of the balance sheet, and the cash flow, and the income statement. And so that's what I explain here. I just use that. Here you can look at some historic ratios. I kind of spent too much time on it and get the financial statements. So that's it. And that's a pretty easy tool to use. Okay, I'm sure most of you have Bloomberg and pay for all these other things and maybe get it from some services, but if you want it for free, if you're a student, it's right there. Now, oh, some guy's yelling in the background. Now let's talk about the key thing about really modeling some of this stuff, and I think it's scenario analysis. And it's not really interesting to me. I have no opinions here, but I have seen what's kind of interesting is my brother in Amazon made a financial model of his business. I go, oh my God. He even said he opened up this thing called Excel. And then you see on the television all these different scenarios of how many people get the virus and whatever, flattening the curve. And then there's the same kind of thing here. This is the economic scenarios. It's kind of the reverse of this, isn't it? Where they go down. And now what I'm gonna show you is a little corporate model. And in this corporate model, here's what we're gonna do. We're gonna make some of the same kind of scenarios here, and I'm going to show you how to set up these scenarios, set up the kind of base cases, the cases with the virus, look at the effects on the value, and then we're going to get into a little bit of the details of this. How just efficiently, everybody can make a scenario analysis. I know that. God, I know that. I'm being proud of making a scenario analysis, my God. But how to make it effective and how to do it carefully and how to present it, I think that is a big deal, okay? And so we'll start with some basic principles of scenario analysis. Keep it on a damn page. Oh, the reason I've been not making videos is I've had a torture chamber session where I've been restructuring models, that these 15,000 line models where they split up, they mix up the scenarios. It's a gigantic error to not put them in a separate, distinct page. And I think you always use the index function, not the damn offset and all that stuff. Make a drop-down box. Who cares? It's not just a gimmick. I'll show you. And then check the scenarios. I'm going to use a data table, which I hate kind of to check it. And here's how I just set up these scenarios in a different page. And now I'm going to open that other model. So I closed everything else up, and I'm going to open my little model here that I wasted time making. Here's our little summary. I'm going to put everything back to kind of a no virus case. Here's the actual stock price now. Looks like I have the things not on automatic. So here's, and what we'll do, this resets the whole base case, and then you can run different kind of cases and see what the effects on the value are. And I'm going to emphasize how some of the mistakes you can possibly make and what the effects of these mistakes are. And then I'm going to show you kind of how you can switch these little buttons. So if we, for example, put a lower discount rate here, or lower weighted average cost of capital, the value goes up. What's interesting is not about that, but how the value goes up in this case. And then you mess around with these things, but then when you're finished messing around with this, you want it to put back to the base case, which it was what I just did. And I'm going to show you just a very quick kind of survey on how to do that. Here's the case. Now, when I did this, please use this. I beg you, please use this generic macro file and don't waste time on, even in this stupid one little hour, I'm going to emphasize this. I'll leave it about, I won't even put a title on here, and you can color the sheets, you can do the Shift Control R. Please, I've worked on this a lot. I've even fixed it for different ones, so we just formatted the sheet and put a little conditional formatting in here and colored the inputs. That's all fine, and put the summary things on, blah, blah, blah. So you can make it so you can make as many scenarios as you want. Make sure when you use the index, you put a scenario code number like you do all the time, okay? And once we have that, then we'll also make this other kind of little master scenario, a scenario number just the same. I use the generic macros completely. But I also put a little macro in here, so when I change a case number, it changes these little things over here. These are the drivers for the spinner box. So you can put a whole scenario in with different cases, and at the same time, use the spinner boxes. Okay, I don't know if I said that right. Again, all of this is explained in on my website. Okay, I'll show you that later. Maybe you'll have a question about it. Okay, now here are a couple of the scenarios. I made different scenarios with a sudden decline and then a rebound from that. This is annual data, and there is no way we could make this with an annual model. That would be absurd to make it an annual model. Then I went nuts adding a few more scenarios. If we don't rebound fully, maybe we're going to change the behavior, and I think that might unfortunately be happening. I hope I can still teach in person, except instead of all these online classes. But I'm going to do online shit. I'm going to do it. Okay. And this is a little bit of our scenarios. Now I'm going to talk a little bit about the modeling mechanics. And now, first of all, everything is about the ideas. There's fast modeling standards. Some of these people claim they use fast modeling standards. In fact, they're the shittiest models I've ever seen. Oh, it makes me nuts. But the philosophy is really good. And don't stop the BS coloring. I already showed you. And don't be so arrogant. Like, I hope I'm not arrogant. I used to be. When I was young, I thought I had the best models. Bullshit. They sucked. Make some, have an open mind, and don't use all these. Don't. I love the indirect, but stop it. Okay. And now, here are some of the things I'm going to go over. What happened in 2008 when that demand goes down? Your inventories don't go down. When demand goes down and cost of goods associated with sales go down, demand, and if you model it as inventories as a percent of cost of goods sold, that's a mistake, especially in the short run. Timing is really important. You cannot make that if this period of crisis, how ridiculous would it be to make an annual model? Make your model so it changes the periodicity. Make sure it changes, and make sure you get to understand what's a fixed and a variable cost. It's absolutely crucial. When you can fire all your people immediately, that's variable. That's what everybody wants to do in the crisis. Fixed costs are a disaster in the crisis. Okay, and so I'm going to show you a little bit of timing. So we'll get into a couple of our assumptions. So I have a couple of parameters that says, okay, what's our final, the first historic period, what's the final historic period, and how many months per period do we have in our historic and our projected, and then you go to your. I just left some of the history that came from our other file. I just left it up here. But then as soon as we get to the from the historic period, which they finished right then, I kind of have the balance sheet just at the perfect time. And then you go down, and here's our we make a fiscal year end here, and we set up all our timing, and we set it up really flexible. And hopefully these formulas are all really easy. God, it drives me nuts reviewing other people's models when as soon as you get a tiny long formula, and as soon as cannot take a formula and start, just finding where it comes from immediately with just the F2 button or the control and the square bracket button, that's a disaster. So here you start with the revenues, and it's so important, unfortunately, to split up the price and the quantity. Even if you don't have it, I made a simplistic assumption about price and then modeled all the units. And then when we get to cost of goods sold, I did it both ways. Put a little sum here, and you could do cost of goods sold, but the much better way to do cost of goods sold is understand how many purchases you made, and understand that in this period of the crisis, you start with your opening balance, you make your purchases, and then the sales go down. So the inventory goes up. It doesn't go down with the lower cost of goods sold. It doesn't go down like this simplistic method would have you do. It goes up, and when it goes up, of course, then when you model your working capital change, you don't have this reduction in working capital. And then I put a little checkbox to show you the effect of this. Now I have it on the no virus case. Of course, that's an idiotic thing, but let's put it on the virus case, and then you can see the effect on look at this. I'm looking at this number and the large effect of modeling the cost of goods sold carefully with that. Now, when you model capital expenditures, this time, first of all, if you model capital expenditures based on some kind of capital expenditures of percent of sales, then capital expenditures will come swishing down. Okay, but you don't really want to do that. You want to directly. What I did here was model capital expenditures as a percentage of depreciation, and then I said, okay, well, we have a period with our timing. We have a period where we have a really low capex, but then we have to make that capex up eventually. Okay, and we put a little flag. If you don't make it up, you're going to distort it. You might get a higher valuation because you cut the capex in and you assume the company rebounds to the same level of sales. This is the kind of a mistake I would make. And then when you model your admin expense, where did I put that one? Okay, you model your administrative costs, split it up between the fixed and the variable items. And I put this a little bit in PowerPoints, and I have a little quote where they, said they're gonna cut all their capitalist spending and cut all their people, of course. Oof, oh, that's sad. Okay, and I showed how the difference is and showed the effects on the valuation. Now I'm going through this very quickly. I hope it gives you a little bit of idea of just setting up models and being flexible. Don't follow some, don't, one of my favorite quotes that my friend who died of another virus in the 1980s. He was the best. He kept on saying, he was a lawyer, he kept on saying foolish consistency. He was a hobgoblin of a goddamn petty mind if you're always consistent. Put these sections in and model it differently, and who cares? As long as you're very transparent and all of the formulas are easy. Oh my God, that's the important thing. And then make a valuation. And in your valuation, put a sum here over here and make a nice little cash flow forecast. And I do different valuation methods. Now I have to keep track of the time just a little bit here. Let me see how I'm doing. Okay. 25. Oh, this is fantastic. It's not as bad as I thought it would be. God, you can get through this stuff in a reasonable amount of time. So here's our parameters. Now, if they come from a different sheet, what I should have done is click on this one that says mark links from another sheet so we can show you where they come from. I'm working on this. I have a thing where you can mark the dependence from cells, and you can do a whole bunch of stuff here. It takes a tiny little bit longer, as you see. All that red stuff comes from different sheets now, okay? And then what I did, so I just standard kind of free cash flow, but you can see now, let's look at a couple of things. Look at the CapEx, look at the inventories, and if you have a no virus case, it's kind of, oops, that's about the same. Now I'm going to put our correct model here. In the no virus case, we have that kind of change, and then not so much of a change. But what happens is we have this enormous working capital increase in our virus case, and we can make the kind of slower rebound case and see what happens to all the cash flows, and then look at the capex too. In the no virus case, they're the 6 billion. If we put the base case in or the other case, they stay at about the same level. If you don't do that, the value goes up because you made this error in the capex. Let's look at what the effect of our inventory method is. If we have right now, if I press this one, it uses regular old cost of goods sold. So we start with, let's look at my favorite valuation. I'm going to talk about this one. This is, it's 17 with the no virus case. Then we have a case and it goes down to 12. Now, if I use the other case, it goes to, what was that, 12 versus 11? But it's okay. It's a mistake. If you made the mistake, ooh, I did make the mistake. If we didn't fix the capex, you can see the effect on the value. And this kind of stuff, there's no rule or anything else. Of course, you should include a flag for this is going month by month, and you just need to use the XNPV, of course, to I say, of course, as an arrogant little jerk I am. Whatever, the XNPV, you can then work with different dates and all that stuff. And then I put different valuation methods. Now, the valuation methods, that really is, here, we just use a growth method. We just take the very last period, the terminal period, and say, okay, take that and put a little flag for the terminal period, and then say, okay, take that last period, multiply it by 1 plus g divided by WAC minus g, and that's your standard growth method. And I did something horrible. You should always include some stable adjustments here, and that simplistic method kind of drives me nuts. What drives me even more nuts is this naming it after this Gordon jerk who tried to increase my utility bills. Ugh. And then you could do the same kind of simplistic method just by putting in a EV to EBITDA ratio, and interestingly, we get not a very much different valuation when we happen to use this discount rate. And then I use this thing that's put in this McKinsey book where you say, go to that last period and take the no plat, whatever you want to call it, times 1 minus G over ROIC divided by WACC, that means you got to put a ROIC assumption in here, which I did. Okay, and then you get the terminal value. Now, I think that by far the best method is not to do it like this, but start to take the invested capital, multiply that by ROIC to get the NOPLAT using the invested capital from that last year. So what you're doing is saying, look, by the time we finish this crisis, the real long-term value is affected by that return on invested capital on the assets. That's why if you have planes that last 20, 30 years, or if you have a hotel that lasts 50 years, or if you have businesses like these department stores, which are horribly being destroyed by Amazon, it's still better to just figure out what you think the long-term return on invested capital and get a valuation from that. This one gave me a kind of high value. I can't stand these McKinsey values. I hope nobody from McKinsey's going to be there. Oh, I hope I didn't insult anybody. And then, of course, you can use a little match index and get, or no, lookup. I used lookup to get the equity value and put the debt in, and be careful with some other adjustments, not only cash, but investments and deferred taxes related to non-operations, blah, 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 the bridge. Okay, and then you get these different valuations. And now let's just do a tiny little bit of analysis on it. Finally, finally. All right, and okay, so here again, if I use a lower WACC, okay, and I put in our no virus case, everything works. And then I can just push this WACC even further down, get an increase in value, okay, decrease in value. This kind of shows you the history of the stock price and where our value is. It seems that we have kind of maybe a little bit of an optimistic value with this low WACC, okay, so I can push it up. Basically, I'm trying to back into the WACC that gives me kind of a reasonable number. Now, if I want to get back to where I started, I can use these little these little spinner bucks and get back. And I think this tiny simplistic idea that I never used to use is important. And of course, if I apply this method, kind of I showed you before, I'm looking at these changes and comparing it to kind of a base case. All right. And it seems that I changed something, but I'm going to leave that here. I'm going to have to fix that. Yeah, I'll fix that right now. Okay, whoops. In my master scenario, I made a little data table, but I didn't use a data table function. I used a macro. Okay, and I have to reset it. Of course, you can look at all the macros. I'm giving you this sheet. Oh, yeah, no, I haven't made all these models for a long time. I had some personal issues with my father and whatever, and his dog. And then I don't want to talk about that. Then but it feels good to make a video again. I was kind of afraid. Now, if I, okay, put this base case in, okay, then it kind of gives me a benchmark. So if I put a low case, this is this kind of orange number. Here's the rebound, so I can see what's happening. And then since I'm belaboring this inventory point, I show you that, and show you what happens to the return on investment, which is something you should always look at, which it stays pretty low. You know, if you assume the return on investment is going to go up by changing this, it'll have a big effect. But what I really want to show you is now, so right now we have these, they're all the same kind. That's unfortunate that they're all the same sort of values. Let me change the, well, it's too long. Let's make it go, I don't know, change the explicit period a little bit. Okay, enough. All right, now if you assume that the fixed costs are less, then you can see that these differences here are getting smaller. If everything's variable, you know, then we're getting a lot of the stuff back. A little bit worried that was almost too good. Okay. But that's the kind of thing you want to demonstrate. Of course, we'd have to make the same kind of assumption in the base case and adjust the base case. That's why. And then if you stop all the purchases, if somehow you can stop all the purchases, then again, the value is going up. This says, okay, after we have an inventory shock, we don't have to buy anything more. This says, if I'm going to sell some new dresses or something, I still have to buy something. I can't just use all my old inventories purchases. I still got to buy it. So those are the kind of, they're important. And then if I can reduce the capex some more, then I can get a little bit more cash flow and value. If, of course, I make a mistake in there, then I get a whole lot more value. But this says I have to make up those reduced capex after I change them. I think that's getting somewhere. So let's, but now let's, I want to, if I change these scenarios, everything goes back. So after switching these around and studying them and showing them to your boss, then you can put them back. Now, to do that, when you make these little drop-down boxes, you put the simplest of simple macros in here. This maybe looks like Greek to you, but it's so simple. You're just copying make sure once you compute the index, you're copying it to a value. Then I have to multiply it by these thousands because of these spinner box things. But that I can get the best of both worlds by doing that. Of course, you can look on my website and get detailed videos and instructions and all that for it. And the final point I just wanted to make is now it's going to be a little bit more difficult. We have to use a little bit of memory here. Let's take our no virus case, okay? Let's use this 17.81. Now, if I put a little bit lower cost of capital in, well, hang on. Let me go back. Let me do it again. Base case. Okay, I hope it put it all the way back to the base case, 7.3, whatever. How I came up with that is God only knows. And it's wrong. Okay, we're back to this one, 7.5, excuse me. Okay, now if the difference, now we put this rebound case in, and we get a difference of 9.1. Okay, that's our difference. Now let's now let's go back and say we have no virus case, and this illustrates kind of how to do this. Now let's change the WACC to 6. How's that? Change it all the way down to 6. Okay, and that WACC is just such a gigantic assumption. It's the return you need. Now in this case, the stock price is 29. Okay, good, whatever. And now let's put our base rebound case in, and this time the stock price is 19. Oh well, it didn't work as much. I wanted it to be, it's about the same difference. I was hoping it would be much smaller, and because of this, maybe it's because some terminal value assumptions and everything else, but that's what oh well, it was worth trying that, okay, in illustrating kind of what you can do. So that's it. And this is a lot shorter of a video than I ever thought it would be. Okay, and now I'm going to have a chance to talk a little bit about the project finance aspects of this. So I'm stopping this one.